Hello students, welcome to Accounting Explained at Accountwise Academy. This is Latha Venkateswaran. In this video, we are going to learn about accounting rate of return. Accounting rate of return. Accounting rate of return method can also be called as average rate of return method. This method focuses on the average net income generated in a project in relation to the project's average investment outlay. Average net income is the total income divided by the life of the project. Okay, if the life of the project or investment is 5 years, then the total income earned from the project for the 5 years divided by 5 will give you the average net income, and the project's average investment outlay is total investment divided by 2. Okay, this method involves accounting profits and not cash flows. Cash flows, we know cash flows are cash coming in and going out of the business, whereas accounting profits are project's income minus project expenses. So ARR considers accounting profits and it does not consider cash flow. Merits of accounting rate of return. It considers all the years involved in the life of a project rather than only payback years. If the life of the project is 5 years, then ARR is going to consider all the 5 years. Then what is this payback years? The other name for payback years is payback period. I have uploaded around 3 videos for payback period. I shall be sharing the link in the description box. You can go through those videos for better understanding. Now, I will give a very brief description about payback period. Suppose the investment cost of the project is 1 lakh and the cash flows you are going to get from the project are first year 10,000, second year 40,000, third year 40,000, fourth year 10,000, fifth year 5,000. Now payback period is where you are going to take that investment out. Here at the end of fourth year your investment you have earned. So 1 lakh, 10,000 plus 40,000 plus 40,000 plus 10,000 is 1 lakh. So the payback period for this project is 4 years. But accounting rate of return is going to consider all the 5 years and not only 4 years. That is the payback period. It is going to go beyond payback period. Okay. ARR applies accounting profit as a criterion of measurement and not cash flow. See here in payback period we consider cash flows. But ARR is going to consider profit, accounting profit, that is the profit you have earned from your books, that is seen in your books. Demerits of accounting rate of return. Each applies profit as a measure of yardstick and not cash flow. ARR considers only profit and does not consider cash flow. While ARR is one of the methods of capital budgeting mainly considers cash flow, but ARR considers only profit. This can be termed as one of the demerits of accounting rate of return. The time value of money is ignored in this method. Time value of money is very crucial for capital budgeting because we all know rupees 100 today is of more value than tomorrow or in the future because money always depreciates. Okay, so that is totally ignored and that is one of the major disadvantage of accounting rate of return. Yearly profit determination may be a difficult task. Here in ARR we are taking one project or investment separately and we are finding profit for it. Finding a profit for separate project or investment is very difficult and it takes lot of efforts to find out the project's profit separately. So that can also be termed as a major disadvantage of ARR. Formula for finding ARR. The accounting rate of return is the ratio of the average after depreciation and after tax profit divided by the average investment. So it is the total profit after depreciation and taxes that divided by the average investment. The average investment would be equal to half of the original investment if it were depreciated constantly. We take only half of the original investment considering that it is depreciated constantly. Suppose if it is depreciated at 10% constantly, and if the life of the project is 10 years, then every year 10% of the project will be reduced, right? Similarly, instead of depreciating it every year, we consider the average investment, that is original investment divided by 2. Here ARR is equal to average income divided by average investment, where average income is total profit after depreciation and taxes. So we have to take profit only after depreciation and taxes. Remember this, okay? This is very important. Profit after depreciation and taxes over investment period by number of years. Okay. So how much ever total profit we have earned over the investment period, that is if the investment period is 5 years, total profit after depreciation taxes for 5 years divided by number of years, that is 5. Average investment would be equal to the original investment plus salvage value divided by 2. If there is any scrap value which we are going to get out of that investment, suppose a machinery you are investing in, that is a project for you, and if the machinery is going to be sold in the future at the end of the life of the machinery for some value, that has to be added back to the original investment of the machinery, and that has to be divided by 2. Total of original investment plus salvage value divided by 2 will give you average investment. Acceptance rule for ARR. This method will accept all those projects whose ARR is higher than the minimum rate established by the management and reject those projects which have ARR less than the minimum rate. Suppose if the management has given the minimum rate of ARR as 10%, whichever project that has more ARR, that is more than 10%, will be accepted, and if the project is going to have ARR less than 10%, then those projects will not be taken forward. This method would rank a project as number 1 if it has the highest ARR, and lowest rank would be assigned to the project with the lowest ARR. Suppose there are 3 options for you and you have to select one project. Option 1 gives you an ARR of 11%, option 2 gives you an ARR of 15%, and option 3 gives you an ARR of 13%. Management is going to rank the project as per the highest ARR. So option 2 will be ranked 1, option 3 will be ranked 2, and option 1 will be ranked 3. And since option 2 has the highest ARR, it will be selected and it will be taken forward. Let us solve a question on ARR. From the following information, you are required to find out average rate of return. An investment with expenditure of rupees 10 lakhs is expected to produce the following profits after deducting depreciation and taxes. First year 80,000, second year 1,60,000, third year 1,80,000, fourth year 60,000. This is the question and this is the solution which we are going to see. So the formula for ARR is average annual profits after depreciation and taxes divided by average investment into 100. Average annual profits after depreciation and taxes is total income for the life of the project divided by the life of the project. So first year it is 80,000, second year 1,60,000, third year 1,80,000, fourth year it is 60,000 divided by 4, which comes to 1,20,000. Okay, average investment is investments at the beginning plus investments at the end divided by 2, or original investment plus scrap value divided by 2. Either of the formula you can use. Okay, here now only the opening investment it is given, neither the scrap value nor the closing investment is not given. So you take 10 lakhs divided by 2, 5 lakhs is the average investment. Accounting rate of return is average profit after depreciation taxes is 1,20,000 and average investment is 5 lakhs. 1,20,000 divided by 5 lakhs into 100, 24% is the ARR. What they will do is management will compare this percentage with other similar projects with similar industries to see whether this investment yields the highest rate of return to be selected. If this ARR is more than the average investment of the industry, then this will be selected or else it will be rejected. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.